So we're going to real quickly go through the last few problems and then get into the math of insurance, which I like a whole lot more in this class than I do in the property and casualty. It's a lot more straightforward, mainly because in life insurance, we have mortality tables. In property and casualty, we don't have anything like that at all. So it's much more complicated. For the last few products, just so you know what else is in this industry, disability income. That's insurance you buy if you get injured or sick. It's going to pay your salary while you're recovering. Most of it's group insurance. Most of you will never buy this insurance because your employer will provide it to you. They may call it sick leave or long-term disability, short-term. That's a whole. You won't even notice. You might be covered by your sick leave policy. You might be covered by a disability policy. It might be workers' comp. You don't really care. You just want your pay. You don't care which insurance plan it comes out of. So much of it's group, but you may need an individual product. And there are people who do buy individual products. If you start your own actuarial firm, you may need to buy disability insurance. Who's the biggest disability firm out there with a famous animal as its mascot? Aflac. Yeah, Aflac. How many of you know that Aflac sells disability insurance? I think that's a big weakness in their commercials because do you work for Aflac or not? I mean, you can watch their commercial and have no idea it's talking about disability insurance because you're so enamored by the stupid duck. But yeah, they're very, that's the big part of their business. It's a difficult business when it first came out. Can we actually sell this? Because wouldn't people rather be at home getting paid watching TV than at work? So are they going to fake an injury, injure themselves on purpose? So there's anti-selection issues. With group insurance, it works as long as you cover everybody. That way, the people that are most likely to want to do this aren't the only ones that get the insurance. So if the employer provides it for free to all employees, the insurance company says, well, at least then we're getting money for everybody, and those few that are going to maybe fake an injury, they'll be a small part of the statistics. You might actually need disability insurance more than life insurance. They both cause a loss of earnings, but disability, you still have to pay your maintenance expenses. If someone dies, they don't have to pay for groceries and rent and all that. But if you're disabled, you still have all those expenses. Plus, you still have to keep saving for retirement. You got all these other things. So it can be a much more difficult need. And you're actually, for some people, more likely to be disabled than you are to die in your 20s or 30s. Social Security does provide some disability insurance, but it's very restrictive. It's also, if you read the articles, somewhat bankrupt right now. So it's paying out a whole lot more than it's bringing in. We usually break it between short-term and long-term. It's just the way the nature of the business and how they price it. So short-term might be up to 2 years. So your sick leave or whatever they call it, your time off, paid time off, that might cover you for a few weeks, and then short-term disability takes over, and then long-term disability takes over. Long-term might cover you the rest of your life, or it might end at retirement age. Insurers fear that people are going to fake injuries so they can get this insurance. The way they cover themselves is, first of all, don't make it too lucrative. So if you get injured, you're not going to get all of your pay. You may only get 60–70% of your pay. You may be some max coverage. It might be offset by other coverages. If it's workers' comp, it may not cover you at all. Usually workers' comp, if it covers it, nothing else does. It has restrictions on who's covered and how many have to be covered, just to make sure people aren't buying it because they have a propensity to use it. And yeah, it offsets duplicate coverage. So it is somewhat restrictive. It also is curious about what type of worker. The general sense is people with a college degree and are professionals, they may enjoy their job enough that they don't really want to be injured and get off to work. Versus a blue collar worker, they're probably sick and tired of the factory job. Nothing would be better for some of them than to get injured and get paid for sitting at home. I don't know if the statistics support that or not. I know some professionals that hate their job a whole lot as well. What does it cover? So there's a big difference between accident and sickness. It's easier to defraud an accident than it is, a sickness than it is the fraud and accident. So So there may be restrictions on one versus the other. It only covers non-occupational disabilities because that's the purpose for workers' comp. So, and they do have waiting periods. They don't have deductibles. They have waiting periods. So you have to be sick for a certain number of times or disabled for a certain amount of time. Usually your sick leave or your paid time off covers that period of time. And then it takes over. You're not actually not covered. You're just covered by different policies. And then for long-term disability, there's a waiting period. Usually what happens is if you're still injured after the waiting period, it might go back and make up for any loss that you had during that time, but you got to make it that far. So that's part of their encouragement to keep people from faking an injury. And the definition of disability is probably the most important part. If you cannot work in your own occupation for the same pay, you're considered disabled. So if you're a heart surgeon and you can't do heart surgery, you're disabled. The fact that you can teach in college, you're still disabled. That would be the most restrictive. That's the best and the most expensive. The second one is you can't be gainfully employed for the skills that you have. So you're a heart surgeon, you can no longer do heart surgery, but you can teach. You're not disabled in that case. You can't work in a job that you could reasonably expect to become qualified. So you can change for another job and become qualified. You're no longer disabled. Or you can work in any job. So you're a heart surgeon, but you can't do that, but you can work at McDonald's. You're not disabled. That's pretty restrictive. Some insurance says forget all of that. Let's just look at how much income loss, and we'll cover the income loss. If you're a surgeon and now you're teaching, how much was that income loss? We'll make up the difference there. So you might say, wow, this is the best, but it's also going to be the most expensive. So each one has the pros and cons. The best story I know of this was a heart surgeon who injured his hand. He could no longer do surgery, so he was disabled. So he became a stock portfolio manager, probably making 3 times more money. And so when I met the guy, I was like, you're pretty smart that you can switch careers so radically like that and still be exceptional at both of them. Injury, it has to be accidental or unintended. Sickness, it's going to exclude pre-existing conditions like most health insurance policies do. Group policies aren't as restrictive on pre-existing conditions. You may have to work at the firm for a few months, and then if you make that, you're covered even if you have a pre-existing condition. These policies have a really strange benefit called waiver of premium, and what they mean by that is you're now injured and you can't work, so you can't pay the premium of the policy. So the insurance company says, hey, well, you can't pay the premium, so we're canceling the insurance. And the policy says, no, if you can't work, your premium is waived. You're still covered even though you can't pay the premium. Now, what I thought it was strange as an accountant when we did this is we had to actually do an entry for this waiver of premium. So we actually counted it as income and counted it as a benefit. So our revenues went up, even though we were paying ourselves. We paid ourselves this premium, and then it was up on the other side. So it propped up the revenues for some reason. You got to notify the company that you've been injured. They're going to look at what kind of career you have to see how dangerous that is. So think about your retirement savings. You can't just say, hey, I'm injured. I don't have to put anything in my 401k plan, because you still could live another 30, 40, 50 years. So who knows? Disability income is insurance, so it can be exempt from taxes. I'm not going to show you these moral hazards. Some of these are almost pathetic, but there are some fraudsters out there. A lot of these videos are looking at, you almost can't tell. Some of them are saying defrauding Social Security. Some of them are defrauding workers' comp. Some of them are defrauding disability income. So it doesn't matter. Now, if y'all watch The Office, is that too old? The Office, y'all still watch The Office or not? That's too long ago. Y'all do. See, I remember who's the accountant? Oscar? Didn't he commit disability fraud at one point? So I think that was actually probably disability income fraud, not workers' comp. I don't think he said he was injured on the job. So I'm not sure how accurate that TV show is when it comes to these kind of things. All right, I won't read this article. You can certainly read through it, but essentially it's saying one of the reasons participation rate in the US has come down. There's fewer people of working age that are working, is so many people have been filing disability claims with Social Security. So if you want to see that as an argument, they make that argument in here. So you can read that on your own. But just looks at a really high increase. So that means the unemployment rate may be higher than we're reporting, because unemployment rate is only the number of people unemployed that are seeking a job. If you're out on disability, you're not seeking a job, shrinks the workforce. So, and it shrinks the number of people disabled. So, all right, so that's disability income. Long-term care insurance. The big player here is Genworth, which is a firm that's looks like they're going insolvent. Really tough one. So it's essentially covering your nursing home care if you have to spend time in extended care at the end of your life. Very, very, very difficult insurance to sell, which I think is the reason this industry is struggling so badly. We're living longer, better health care. So there are people living longer with these chronic ailments. Baby boomers are aging out. But there's also the issue of anti-selection, that people who think they're more likely to go in nursing care are more likely to buy this, and how much knowledge do they have. So that one's pretty tough, especially with the Human Genome Project. If someone can tell you you've got a 95% chance of getting Alzheimer's, you might say, yeah, I better buy some long-term care insurance. If the insurance company doesn't know that, then that's certainly going to cause issues. The care can be in-home or institutional care. Medicare does provide some coverage, but it's pretty restrictive. In fact, I've been pretty shocked at some of the times when it doesn't cover it. So what is a disabled? Someone who can't do two of these activities. But the industry is under major stress. It's really been seeing its costs rising dramatically. I'm not sure. I know some employers have talked about providing this as a benefit to their employees, and most of them have looked at it and say, you know what, forget it. We're not going to do that. It's just too dangerous. It's too dangerous for us to offer it, and it's too dangerous for us to hire an insurance company to offer it, because there's a good chance they're going to go insolvent, and then we got this big mess on our hands. So I doubt you'll be able to find this. There was talk at USAA of offering this. I don't know if they're offering it now, but should you buy it, and when should you buy it? I think you're going to find, according to this article, if you read, there's Genworth right there, 33% of the market share, but a firm that's just they're almost a penny stock. It's just really it's falling apart. It has their stock price dropped dramatically in 2008, and it's essentially stayed down there most of that time. It's just gotten really expensive because the industry is discovering they're losing a lot of money, so they're increasing their rates really rapidly. And when you increase your rates really rapidly, that encourages more anti-selection. The people who really need it are going to stick with it. People who don't need it are going to cancel the policy, so it gets worse and worse. You know, if Alzheimer's runs in families, people might see a relative who had it. That may make them concerned. So, you know, there's a lot of issues there. The Human Genome Project, I don't know if you're familiar with that. I had to do a project in my graduate school on that. But mapping the DNA, trying to find certain parts of our genome, our cell structure that gives evidence of certain diseases that might hit us, especially Alzheimer's disease. There are genes that point out we have a more likely chance of getting Alzheimer's. And so the issue here is, what do you do with that information? Can your employer get that information? Can an insurance company get that information? Is that private information? I think genetic testing is still pretty expensive. I haven't tried pricing it in a while. How much for genetic testing? You'll see a price anywhere? How much is genetic testing? I hate to do the ad ones, but yeah, they're like 2 trillion come up. You can save $40 here. That's Ancestry. Have any of y'all tried that? Ancestry testing? That's have you tried it? Yeah. Was it like $40, $50, or?
They had a Christmas special, so it was cheaper. I did like the combo, which was like the health and the genetic.
Oh, really?
Paying around like 100 with the deal.
Was the genetic helpful at all, or scary? Were you like nervous to open it up?
Well, a lot of my family, because they're from the UK, actually use Ancestry, so they did pop up on the 23andMe. So I got a bunch of random people that I never heard of.
Yeah.
As far as like where I was from, I feel like it was pretty accurate. It was mostly Europe.
But was there anything medical wise that they give you? Like you were
Um,
susceptible to heart disease or anything like that?
So yeah, for the health, it was made.
I mean, you don't have to tell us what it was.
Well, on my mom's side, asthma was pretty big, so it
Okay.
said that there was a high chance of that, but I don't have that, so I don't know. But there were other things that.
So I picked that up. They didn't know your mom had it, but I still picked it up.
Yeah,
and told
so
you about.
there was a few things that were in my family's history that said I was at risk for. So,
Yeah, I don't know how much on these that they test for, but you can get it can get pretty expensive to go all out. So I've been trying to find it's a PBS special, and it's so fascinating, but I cannot find it. One of these days I'm gonna find it, but such an interesting interaction. This lady gets a genetic test. I think it was for heart disease. I can't remember exactly what it's for, but she wanted a specific test, and in that test, they discovered she had a high probability of Alzheimer's. So the doctors are talking. You see them on the film talking to each other. Should we tell her or not? She didn't ask for that. She may not want to know. They don't know what to do. So next time they see her, she comes in and goes, "Doctors, could my heart problem be causing memory problems? Because I'm having really bad memory problems." So now they really have a dilemma. So they decided to tell her. She took it really, really well. She said, "I'm glad you told me that. I can prepare." But then she told her sister, you probably should get tested." Her sister said, "No way, I don't want to know." And another part of that program, a young lady, probably in her 40s, I don't think that's young, but it's young to me. A young lady in her 40s, she got tested and had a high probability of Alzheimer's, and she regretted getting the test. She's like, "Oh, I wish I hadn't got," because now what do I do? I got my kids in high school, what am I do? So she was pretty upset. So I don't know if I want to know or not. You can't rely entirely on your family history because there could be things there that are coming from, a great grandfather or something. So there is a Genetic Information Non-Discrimination Act, which is trying to protect people from that type of information. But all right, so y'all can read through that articles, but interesting stuff. And the problem is, it's amazing how complex the human body is and the DNA is. So it's just massive amount of information. But with this new computer power they're finding now, that they may get the point, especially with AI, they may get the point they can just do it a lot faster, and they may map our genome much faster. And they may tell you exactly when you're going to die and what and all that kind of stuff. Who knows if you really want that information? And the other thing is they may find cures for Alzheimer's or cures for these kind of things. So who knows what will happen. All right, accelerated benefits. This is a really fascinating one. So especially related to the industry, the competing industry to this. So accelerated benefit, what they're saying is, hey, you're really sick. You're going to have some serious medical issues. You have this life insurance policy. It's obviously going to pay out here pretty soon, but you're going to have massive medical bills until then. You can wipe out all of your inheritance for your kids by paying your medical bills, or we'll pay you your life insurance at a discount. You can use that to pay your medical bills. Now, your beneficiaries are going to lose either way. Either they're going to lose all their inheritance because you're paying medical bills, or they're going to lose the life insurance. But what it says is if you have certain terminal illness after a certain age, after age 65, then we'll pay out your life insurance to you, and at maybe 90% or whatever, so you have something to pay that. So it's pretty interesting. Related to that, let me see where I put that. Yeah, I don't know where I put it in the notes, so I should have put it in the notes. So, oh, here it is. Have y'all heard of viatical companies? How many of you know of viatical? So a viatical, what they'll do, so living benefits is your insurance company is paying you your benefit early. Knowing you're going to die in a couple of years, they pay it early. A viatical will buy your insurance policy from you at some discount, and then they become the one who gets your policy if you die. And so let me just give you an example, because I had this happen to me and I did this. So I had a sick relative in the 90s, in their 90s, very sick, serious heart issues and all kinds of things, obviously 90 years old. The cash value was like $1,000. So if I cancel that policy, I get $1,000. There was no living benefits. So the premium went to, I forget how much, close to $2,000 a month. All right. So I could keep it in force, $2,000 a month, rising rapidly. Each December 1st. So it might be 3,000 in December, it might be 5,000 next December. This person might live 1 year, 2 years, 3 years, 5 years, I don't know. So I'm in this horrible position of, do I keep paying this premium? I was going to pay the premium for somebody else. Do we keep paying this premium? Or do I take the cash value? But the cash value is only $1,000. So that's hardly worth it. So I called a viatical. So the face of the policy is $145,000. How do you spell viatical? Viatical. What does viatical mean? Is that a word? It probably has a meaning. Someone look it up. Viatical. It's probably a normal English word. Y'all could try to use it in a sentence this week. Via, through, but I don't know what the rest of it means. So I went to a viatical and they say, we'll buy the policy from you for $45,000. So what are your choices? I could surrender it. What do I get if I surrender it? I get $1,000. I can keep paying the premiums, but that's $24,000 and then who knows what per year. I'm going to be running through that $145,000 pretty fast. Or I can receive $45,000. Which of these would you never do? Surrender. You would never surrender a policy like this. I know people that do. They get in this is a really tough position because you have this loved one. You want them to live longer, but at the same time, you don't want to pay $24,000 a year. You almost want to ask them, how much longer are you planning on sticking around? This individual throughout their 80s kept saying, I think this is the end. I don't feel well. I'm having real stuff. And then he made another 5 years. You have this comeback. So we were like, man, he could live another 10 years. His relatives all lived really long. So we're struggling with that. We didn't want to get in a position we're going to pay $200,000 in premiums for $145,000 policy. So this was the last choice. So I had to make that decision. Still a tough decision. While I was making the decision, everything changed and it became obvious to keep the policy. And I paid the $2,000 for about 7 months or something. But tough decision. This is not a decision you really want to have to face. However, I would say don't forget about this. And it's pretty easy to do. You just do viatical quote. Now be careful if you go on their site and ask for a quote, you're going to get a phone call every week for the next 7 years. They were calling me constantly. And I kept telling them, hey, right now, I don't think I'm going to cancel it, but I'll let you know if anything changes. And they just kept calling me. So once the person passed away, they stopped calling me. But they're all, you can get a quote. So the quote is based on the subject information you give them about the person, their age, their health. But if you actually want the actual money, they want an actual doctor's appointment. They want to get a doctor's opinion. So they're actually they'll pay for it, but they're actually going to want more detail on that. So don't ever, if you have anyone over the age of 65, don't ever just cancel a policy. Always go out and at least quote a viatical just to make sure. If it's a choice, if you're for sure going to cancel it, there's absolutely no reason not to call a viatical. Now, if you're trying to decide between, then you're really deciding between these two things. Now, what's the viatical going to do? They're doing the exact same thing, aren't they? Because they're going to have to pay this. So they're making the exact same math. If they're paying you $45,000, that's not enough. Because they're going to do the math in their favor. So the other thing I like about this is it tells me somewhat of the life expectancy of the person, given all that data. Because if they're going to pay me $45,000, and they're gonna pay 24,000, or they're gonna pay over 45,000 next 2 years, you know what they think this person's life expectancy is. So they have actuaries working for them. They understand all the math. So that gives me some insight as well. That might help me know whether I need to pay this premium or not. So, all right, so there's a viatical. They're actually pretty, the insurance industry hates these people. They talk about them like they're shysters. Somehow the industry talks about how these people are ripping their customers off. But I mean, the insurance companies can give me 1,000, they're giving me 45,000. Where are they ripping me off? I don't really see that. So I just don't think the insurance company likes competition. All right. We talk about end of life. You might click on, I don't know if you can get to these because they're economist articles, but these are articles about allowing people to die on their own terms. So it's gaining acceptance. So we won't look at these articles, but there's plenty of articles out there if you want to add that to your paper too. Group insurance, just real quickly, group insurance, that's what most of you'll get when you go to an employer. It can be group life. At USAA, I got one time my salary for free. You just take it. You can buy more. People buy more. You have to go through underwriting, blood tests, medical exams, because they assume people buying more probably need it more. But you get one time, so you do have some coverage there. Your health insurance will probably be group insurance. Your disability will probably be group insurance. So you're getting a lot of group insurance. Most group insurance on the life side is term insurance. This is a huge issue for USAA because USAA insured its own employees through its life insurance company. And they had some really high paid employees that were not that healthy. And they were like, boy, we need to bring up our premium quite dramatically because they were concentrated into the execs. So we actually had this information. We were actually looking at our own employees as a business for insurance. The face amount is going to be lower. You're not, you probably need a 200,000, 300,000 insurance. You're just going to get your salary one time your salary. So it's not going to cover that much. You get a group contract. The coverage is based on the group and its characteristics. So the file you send the insurance company is the gender and age of the workers. You don't get much, you don't get any information on their health. You don't get weights or anything like that. So all you have is gender and age. And so it's group underwriting. So they're just using generic information. There may be information like if it's Cheat General Motors, it's a big enough employer, you may have specific information from that employer. But generally it's based on the average employee. You have an open enrollment period, which is, someone has some horrible illness. They could join the company during the open enrollment, get insurance, and not be underwritten, and they would have insurance that would pay off really, really well. So you got to make sure that the group doesn't exist just to get the insurance. It has to exist for some other reason. Otherwise, the only people joining the group are the people who really need it. And you need a group that's pretty stable because there's a lot of administrative costs to this. People come in and go out. You don't want to be constantly replacing people. We talked a bit about that. Eligibility, benefits. Every product can be a little different. You want the premium payments, if you're the insurance company, you want them to be non-contributory. You want the employer paying 100%. Because anytime the employee pays more, sick employees buy it, healthy employees don't, so it ends up not being a very good product. The employer can take on some of the administrative burden in order to cut premiums. They might look at your prior experience if you're a large enough company. And we talked about that. What industry is this in? Is it high stress or occupational hazards, this kind of thing? I'm not going to talk about this, but there's so many ways I can calculate it. I think the standard is what I saw, just one-time salary. That tends to be, they might say $10,000 times your number of years of service. Who knows what they might offer? But it's just there. Why do they offer this? I don't know. It costs them money. Would you not take a job because you don't get free life insurance? So I don't know how many employers offer this. It'd be interesting to go see. It seems to be a pretty standard benefit. So I'm not sure why they do it. And who's eligible? The beneficiary designation. And then what happens if you terminate? If the employee terminates, then they lose the insurance, but they might have the right to convert it into whole life. If the employer terminates it, the contract ends. You know, if the insurance company could terminate it. I'm not going to talk about conversion. All right. So most of y'all will have some of that. Check and see. You might ask that. I don't think most people even focus in on. I can't even remember my employee orientation at USAA if they talked about that, but that was like 40 years ago. So I don't remember. All right. Some other really wild insurance, key person insurance. You have one employee at a firm that if they die, the firm ends. We actually did this insurance on a charity I was working with because it was all around this one person. So we got that insurance just because we knew we were going to have to hire someone to take his place. He passed away. He actually ended up passing away to COVID at a very young age. It's a pretty remarkable story. But key person insurance. So you have some major inventor or some major central person. If they die, the insurance pays mainly so you can hire a person with their skills to come in and take over. Works really well with partnerships. And then probably the craziest insurance of all is COLI, TOLI, BOLI. This is when your employer buys insurance on your life and they're the beneficiary. So they buy $100,000 in your life. If you die, they get $100,000. Sounds really terrible. Sounds like they're going to hire hitmen on you if they're struggling financially. The biggest question on this is how in the world does your employer have insurable interest? And so far, it's won in the courts that they can buy this insurance on your life. Why do companies like this? Well, because it's like regular insurance. If you die, they get the insurance. It's tax-free. It's all about taxes. It's the only reason they do it is for the tax. So COLI is corporate-owned life insurance. BOLI is bank-owned life insurance, and TOLI is trust-owned life insurance. The company I work for sold BOLI. I had a trust where we were looking at buying TOLI. To me, it looked really good. I thought, wow, this is too good to be true. I got to do this. But fortunately, we own the life insurance company, so I went and talked to the life actuary, and he said, there's no way your employees are going to die that fast. I said, what do you mean? He says, the analysis they sent you have your employees dying much faster than they will. You're not going to get those proceeds the way you think you are. They're lying to you. I said, great. Who else has access to someone that can tell me that quickly? So I gave them the files. And he said, yeah, they're assuming your employees are going to die like really fast. So we didn't buy it, but they sold this. And the reason he knew it was a great product to sell and a horrible product to buy is because he was selling it. And he knew he was making a fortune off this product. And then the CEO heard about it and shut the whole thing down. He says, why are you selling that kind of insurance? That's not part of our mission statement. And he's like, yeah, but it's like free money. Why not? So he had a fit when they made him shut it down. But I learned a lot. I mean, that's one thing you got to do. If you get your job, you go learn who the people in the company are because they can help you do your job. I learned that very, very early on. But it is entirely tax-free. They want to get that insurance proceed and get it tax-free, and essentially they're making all this tax-free money. All right, I think we've covered essentially every product there is on the life insurance side. Some good ones and some bad ones. We didn't talk about equity linked life insurance, but it's got all the problems with equity linked annuities. So they're putting bells and whistles on everything, but it all comes down to the same thing: who's taking the risk for the investment side. All right, did you bring your calculators? You got your laptops, right? So let's talk pricing. I am not an actuary. I don't know if we'll do calculations tonight, we'll see, but definitely Thursday night we'll start calculating. So I'm not an actuary. The proudest day of my entire career was I was talking asset liability management on the phone, and the guy on the other side said, are you a life actuary? I go, no, thank you very much. It's like the best compliment I've ever gotten. So I sounded smart enough to be a life actuary, if that's believable. But I spent a lot of time with actuaries, especially pricing actuaries. So I can't do their math, but I have a good sense of what they were doing, understanding it in a general sense. I've taken some courses on life insurance pricing, so I'm going to give you a high enough level. I probably can't get you to pass the actual exams, but you'll get introduction enough so that when you see it on exams, you'll have a little more comfort with it. But bottom line, life insurance pricing is this kind of cash flows with the mortality table. That's essentially all it is. So, so in perfect competition, price equals marginal cost. That's what the economists tell us. What the market will bear, how elastic is the product, competition. So if you don't have much competition, you can charge more than marginal cost. What is the buyer? Remember we talked about with health insurance, you didn't have any competition. So instead of charging a marginal cost, they charge the most they could get away with because they knew the person was desperate to buy it. So your cost of goods sold should give you that desired margin so you can make a cost, you make your required return. But insurance is different. If you're selling Pepsi, you know your cost of goods sold before you sell that Pepsi because you made it in advance. You know exactly how much it costs you. You just got to put a markup on it. Life insurance, you don't know your cost of goods sold until everybody dies. And that can be many years from now. So you're just guessing when people are going to die using the mortality table. So you've got to put some cushion in there in case you're like, you know, Pepsi, when they sell Pepsi, they don't have to say, well, it costs us 50 cents to make this. We need to add 30 cents for profit. But you know what? It might cost us 70 cents to make it. So it's, you know, they don't have that problem. But life insurance has that problem. And they have two problems. How many people are going to die and when did they die? So we got a timing and we got a severity issue. So it creates great risk. Going to mean we have to make a higher return because it's a risky product. So it's going to increase our cost of capital. We have to hold capital in case we're wrong. So not only does our cost of capital higher, but we have to hold more capital. So we got to make more money. I'm going to skip this Miller-Modigliani, but make sure you don't graduate not being fully versed in Miller-Modigliani. Could any of y'all write me an essay on Miller-Modigliani? Y'all remember it? What did they say? I do gig, how far do I have to go? There they are. If I click on the picture, you'll see a picture you remember. Y'all remember these pictures? You saw it in my class, right? Lisa, you had to write an essay in my class. So you probably couldn't do it now because it's been a while, but you probably get back to you really quickly, or you might be able to. So their theory was the optimal capital structure for a firm is it doesn't matter before taxes, because if you take more debt, cost of equity goes up, your cost of capital stays the same. After tax, it matters because interest expense is tax deductible, dividends aren't. So what do? You use more debt to get the tax shield, but at some point you use so much debt that become risk of bankruptcy. Y'all remember that now? Maximize the value of the firm where the WACC is minimized. That's the way most of the world thinks. This is not the way insurance companies think. Insurance companies and banks, capital, when they talk about capital, first of all, they mainly mean net worth. Walmart, PepsiCo, when you say capital, they mean debt and equity. Insurance companies, banks, when they say capital, they almost always mean net worth. They're not including debt. Why? Because most of them don't have debt. Their debt is to their policyholders. It's their reserves. So it's a very different business. And so their net worth, how much, and so their debt is tax deductible because it's reserves, but how much net worth they have is not trying to get the tax shield of the reserves because they want to sell as much business as they can. Their capital is how much they need to make sure they don't go insolvent. So it's what the rating agencies and the regulators are telling them. So it's a much different type of business. The more risky you are, the more net worth you need. So let's think about this. Term insurance. Term insurance is very, very, very risky. Why? Because there's no cash value. It's all insurance. So if the insurance company is wrong, they bear all the risk. Whole life insurance, you have a cash value. So if the person dies unexpectedly, part of it, what you're going to pay them is their own money, and the rest is yours. So whole life insurance is not quite as risky. Annuities, we're going to see very shortly, are very, very, very risky. But we'll wait for that. I'll show you that later. Annuities are they make a lot of money as long as interest rates don't change much. And so you have to hold enough capital to convince rating agencies and regulators that you're not going to go out of business. And so it's a very different type of math. This was a big part of my job. 7 years of my career, I was in a department called capital management. And I was on a project called capital management. We could never decide what the word capital management meant. I was in a department called capital management. They didn't take my definition of it. I was like, how could you not take my definition? That's where I work, but they didn't. So it was accountants versus finance. But finance says capital management is managing that debt versus equity side of the equation. And that was my job, is how much net worth does our life insurance company need? How much net worth does the biggest day of my entire career was answering that question. How much net worth does our property and casualty company need? It's a very different question than what Miller Modigliani does. I don't know if Miller Modigliani ever looked at an insurance company or a bank to try to apply their theory. It would have been just really radically quite different. So our cost of goods sold is going to be based on a mortality table, and then the time value of that. We're going to ignore the cushion in this class. And I'll show you what I mean by that. So the price or the premium for an insurance company is going to be the present value of what we expect to pay in death benefits, plus the present value of our expenses. Some of our expenses will happen at day one, some of them will happen throughout, and some of them will happen at the very, very end. We'll talk about that. And then how much profit do I need to make my required return on capital? We're only going to price this part. We're not, now if you take my property and casualty class, we price the entire thing. But in here, we're only going to price that part. That's called the net premium. We're only going to price the net premium. The profit requirement is our required return on capital given our risk times how much capital we're required to hold, also given our risk. So the more risky companies have to make a whole lot more money. So the gross premium, this is what we charge the customer, is the net premium, the amount we need to cover claims, plus the loading. The loading are those expenses and the profit. We're going to ignore the loading for our purposes, just to keep things a little, it's going to be hard enough dealing with the mortality tables. Now, property and casualty side call the net premium the pure premium. If any of y'all took that class last semester, we talked about the pure premium, but essentially the same thing. What discount rate are we going to use? We're going to use a discount rate that reflects what we think we can make on the investment portfolio. Because they give us a premium today, we invest it, and then we pay them a claim, so we use that investment rate. So we're only going to use the net premium. All right, so you need some symbols. I'm not giving you all of the symbols. There's L, D, P, and Q. There's also M and N, but we're going to leave out M and N. What M and N do is they combine the mortality table with those present value interest factors that you did in your accounting classes. I'm not going to do that. It's just too much work. Plus, I don't have the tables anymore. So, but the LD, so essentially you're going to be doing it by hand. So on the exam, I may have to cancel this part of the exam because students do so horribly poorly on this, or maybe I'll do some kind of extra credit on this. I'll have to look back at last semester's. My guess is the class average on this is like 40% on this question. I don't know why. I think part of it is you see it tonight and then you study for it in 2 weeks and it's like you've never seen it before and it's starting all over. Hopefully we get a good recording tonight. So let's learn some of these. Some of them are pretty obvious. L and D, the key is these are the number of. Q and P are probabilities. Do y'all remember in that first article for paper 1, you had the Q in there? So that's what they meant by the Q, probability of death. So L is the number of people alive, and really, really important. They're alive at the beginning of the year. D is a number of people who die during the year, but we're going to assume they die at the end of the year. Now, not only are we assuming that, that's actually what mortality tables and reserves assume. We assume everybody dies at the end of the year, and then we make an adjustment for the time value of that, but we're going to assume, and it makes it much easier for you because we don't have to do any kind of mid-year convention or anything. We just assume, hey, if you die this year, you got to die exactly in 365 days. You can't die anytime before that. QX is your probability of dying. PX is your probability of living. So if you go to our class, and look under miscellaneous materials. We might, if we have time, we'll look at the 2001. There's probably a more current one. So I'll go find, if I can, I'll find the most current mortality table. But you have a mortality table here. We're using a very old mortality table, and the reason is the mortality tables got really complicated after 1980. So we're just simplifying it. Not because, I don't want to update it. It's just they kept adding more and more bells and whistles, so it just got messy. So we're going to keep it simple. So here's a mortality table. We're going to be using this quite a bit. This mortality table, I think, originally started with 1 million people, and on the exam, we don't need 7-digit numbers, so I rounded it down by 10 just to make it so it's not quite so much. So we're going to start with 100,000 people, and guess how many people we're going to have at the end of age 100? Any guesses? We start with 111 at 99. 111 die, so how many are alive at age 100? 0. We're assuming they all die. The current mortality tables, I think, go out to 125. We'll have to look. That doesn't mean they have people alive at 125. I think they're all dead at 125, but the tables go out that far. I don't know what they're doing with all that information. So we're going to start with 100,000 people. This is a male table. So they break it between gender, male, female. They break it between smokers and non-smokers. They break it between select and ultimate. Those are the main ones I've seen. There are avocation tables as well, what your habits are. So gender, who dies faster, the male table or the female table? Male table. What about smokers, non-smokers? Now, how material is it? It'd be interesting to compare the two tables and see how material that is. And then what about ultimate and select? What does that mean? Ultimate and select means they got a table for people who just visited the doctor. That's the select table. And ultimate is people who haven't been to the doctor for a while. So obviously people who just been to the doctor, they're going to have much lower mortality than people who haven't been there in a while. So those are the 3 most common ones you see. So this is, I think, a male non-smoker ultimate table. All right. Now, one thing you'll notice is, with one exception, you notice what's happening to the deaths as I go further along, or mortality. It's increasing. What's the one exception? Why does mortality improve there? Any guesses? What are 25-year-old males doing that's causing their mortality to get better? Marriage may be part of it. Married men do drive better than non-married men, but well, I just gave you the answer. It's driving. Yeah, so it's driving. That's how material driving is to mortality for men. I don't know if you have the same thing with women. I haven't seen that table in a while. So for the most part, mortality, now number of deaths may not increase because you may have so many people dying that you don't have many left, but the actual mortality is going to increase every single year, with the exception of, now if I went back to age 0, there is a higher mortality from 0 to 2 or 3, and then it drops, and then it increases again once you start driving at 18, and then it decreases. I don't know if it's marriage or just getting older or both. So we start with 100,000 people. 177 die. So your probability of making it to age 26 is 99.823%. Your probability of dying is 0.177%. And your best mortality is age 28. You have a 0.1699% chance of dying. Right, so you're going to be using this table on the exam. What I'm going to do, we're pricing, I forget how many products, but several products. I'm going to actually price them in Excel in this schedule. So you might actually want to have your laptop open with this schedule open and taking notes. That may help you keep up with me. And then you'll have the video as well to see it. On the exam, you will not have Excel. So on the exam, you're going to have to do it by hand. So make sure everything you see me do, you can also do by hand. The exam help videos, I do it by hand just like you do on an exam. The nice thing about the exam is most questions I don't make you calculate it. I just ask you to write the formula. So most of the time, I think there's 2 questions I ask you to do the actual calculations. And there's one that's pretty messy. It's a pretty long question with a lot of calculations. I don't count off for math problems. So if you make a math error, I don't count off for that. So you just go through it, make sure you do it correctly as far as the process. So we're going to be using this mortality table. If we put an N before it, you can't put an N before L or D, but you can put an N before these. And N means the number of years, and the X means age today. All right, so X always means age today unless you see X plus 1, X plus 2, X plus 3. So NPQ is the probability someone who's aged X today will live another N years. NQX is the probability someone X old today will die in the next 5 years. If there's no N there, you just assume that it's 1. Now, there's a few rules here that some students get so confused, but what I found with students, if you're confused, you have the mortality table on the exam. I've had students ask me if I'm going to give the mortality table on the exam. Yes, you don't have to memorize the mortality table, if any of you are worried about that. So you have the table. The nice thing about the table is it will help you answer some of these questions. If you forgot, if you look at it and say, wow, how do I interpret that? If you look at the table, it might help you remember how to do that calculation. So remember that cell. So LX plus 1 might sound like it's a bigger number than LX, but it's not. L26 is a smaller number than L25. Everybody understand why that's the case? L26, that's the number of people alive at age 26, is a bigger number than L25. Maybe there's a planet somewhere in the universe where L26 is larger than L25, but in the United States or on Earth, L26 is a smaller number. What is L26? L26 is L25 minus D25, not minus D26. It's L25 minus D25. What is L25? L25 is L26 plus D25. Maybe y'all see that? L25 equals L26 plus D25. DX equals LX times QX. It's the number of people alive at age 25 times the probability of dying at age 25. Which means QX equals DX divided by LX. PX, this is a really good one to know because we will use this. So PX equals LX plus 1 divided by LX. So L26 divided by L25 is P25. You got to get used to where to put the numbers and be real careful with them. PX plus QX has to equal 1. Those are your only 2 choices. You can live or you can die. There's no third choice. I remember a life actuary talking once, and while he was talking, I kept waiting for him to get the third choice because he kept talking like there's a third choice. Where are you going with this conversation? So it's kind of bizarre. But no, those are the only 2 choices. Now this is a really good one to know. NPX, you're going to be using this one. NPX, so the probability someone X today is going to be alive in years is LX plus N divided by LX. If we want to know what's the probability a 25-year-old will be alive in 5 years, we're going to do L30 divided by L25. Now you might say, well, that's kind of confusing because you do 25, 26, 27, 28, 29, 30, that's 6, but we want that, right? Because they're alive at the beginning of age 30, that's 5 years from now, all right? I'm going to help you a lot on this on the complicated problem because it can get confusing. If you're trying to figure out 5P25, is that L30 over L25 or is that L29 over 25? So the nice thing is you just add the N on there. You're going to see, I'm going to do some problems. You're going to see why that's so critically important. But always remember, LX or LX plus, it's at the beginning of the year. So 5 years from now, it's the beginning of L30. It's not the beginning of L29. It's the beginning of L20. You'll see how that is. So 25, 26, 26, 27, 27, 28, 28, 29, 29, and 30. That's 5 years, okay? Same thing with NQX. So with NQX, you have to subtract, but you're still going to use LX plus N. So what's the probability someone 25 years old today is going to live 5 more years? You take L25 minus L30 and divide it by L25, and that's how you would get it. NPX plus NQX has to equal 1. Over the next 5 years, you have to either be alive or be dead. Now, is there a time when this won't add up to 1? And there is a time when we're talking about 2 people, 2 lives. Do they both have to live or both have to die? No. One can live, one can die, one can die, one can live. So we'll find we have 2 people, we're having more combinations to bring together. But if it's just one person, they either live or they die. That's the only choice they have, right? If you're worried, don't worry about it. Most of the problems you're going to see are very redundant. I'm going to show you all these problems to price, and you're going to learn real quickly after about the 3rd or 4th one. It's really only one equation. The question is how many D's and L's are in the numerator, how many L's are in the denominator. That's all you got to figure out, because everything else is, it's just how many years. So let's look at a few of these. We won't go too far here. So 6P45. What is 6P45? The probability that someone who's 45 today lives 6 more years, is alive in 6 years. Which means what? Alive at what age? L50 or L51? You just add L51. So age 51. 25Q25. Some students mix the N up with the X. 25Q25 is a probability a 25-year-old will be alive when? At age 50. All right. What is that probability? None of you are 25 years old, but what's the probability you could make it? So 25P25 is going to equal L25 plus 25 divided by L25. All right, what probability do you think that is? Any guesses? Let's say you're 25 years old. What's the probability to be alive at age 50? Greater than 10% or less than 10%? I don't really know, so I'm just saying how much smarter y'all are than I am. The actuaries know it out to 3 decimal places, but the non-actuaries, what is it? More than 10 or less? What do y'all think? How many think it's less than 10% chance? Wait, I'm sorry, that you'll die. I'm thinking the wrong way. What's the 90? Y'all think my word? What 90% chance. You think I have a more than 90% chance to make it to 50 or less than 90%? Less? How many say less? How many say more? Okay, it's pretty well split. Okay, so we'll do L50. You already know what it is, right? It's 92.7%, isn't it? So 93% chance. So you got a pretty good probability of making it. And this is an old table, so you probably have a higher probability than that. Right, so that's how we're going to be using this table. All right, last one. I'll end up with this one. Life expectancy. The definition of life expectancy is the age 50% of the people make it to. So you have a 50% chance of making it to your life expectancy. So remember paper 1 or article 1? No, it's article 3. Remember article 3? Financial planners say, hey, let's plan that you'll die at your life expectancy. Well, you got a 50% chance of making it further than that. So that's not a good thing to do. If they say, well, let's just add 5 years to your life expectancy, well, you can do the math. You probably have a 30% chance of doing that. So life expectancy is when LX equals 50,000, that's when you know you're there. So what's a 25-year-old's life expectancy? You're just looking for 50,000 here. And there it is. It's 70 on this table. It's 75. It's probably, well, I don't know. Life expectancy has actually dropped the last few years because of COVID and because of drugs, opioids. But a 25-year-old today has a 50% chance of making it to 75. What's their probability of making it to 84? It's pretty easy with the math because I did 100,000. So you got a 21% chance. What's your chance of making it to 90? 7% chance. What's the chance of making it to 100? 0. Is it really 0? No, but that's what the table says. All right. But life expectancy. So if I ask you the life expectancy of a 60-year-old, what would that life expectancy be? You take 83,000 divided by 2. You're looking for 41,008. So 78. Why does a 60-year-old have a longer life expectancy than a 25-year-old? Because he made it to 60. All right, so a 60-year-old, they're not going to live longer than a 25-year-old, but they're going to live to a later age on average. So they're going to live 28 years versus 50 years. But all right, so we'll work through these. But what I really want to get to is the actual pricing. And you're going to see the actual pricing. Now, I'm thinking you're going to find it pretty easy. On the exam, I usually have one question at the beginning with a bunch of these simple questions, and students bomb on those. And then I have actual policies, and most students get all of those right. So you guys are pretty straightforward. So I'll decide how much. Maybe I'll put them on exam, but reduce the weight or something. All right.
Just a couple announcements. The instructor survey. If you do the instructor survey, you get a 1% bonus and then class grades. So get that down. I'll read those really carefully. And secondly, we will have class Tuesday, but what I'll do for you, if you attend by Zoom, you get credit for attendance without showing me notes. If you don't attend by Zoom, you can send me your notes and it won't count against the 2 or 3 Zooms back up. Does that, you understand that? So if no one's here, I'll just be talking to myself, but I do that all the time anyway, so it won't be a problem. But if some come, that's fine. It's awfully late on a Tuesday before Thanksgiving, so if you want to watch it from home, that would be perfectly fine. All right, questions on those 2 things? That's good. All right, I don't know when the instructor survey ends, so just be watched out for that. Okay, we covered this one last time. So we're getting the L's, the D's, the P's, and the Q's. Get some practice with them. So what is the probability a 30-year-old living 10 more years, but not using P's? That would be really easy, 10p30. But how do you do it using Q's? Well, 10p30 is the right answer, but if you can't use P's, then you do 1 minus 10q30. The probability of them living another 10 years is 1 minus the probability of them dying in the next 10 years. We're really asking, will they still be alive at age 40? So you just add the 10 to the 30. At the beginning of age 40, will they still be alive? Another way of writing this, don't forget about this, is L40 over L30. This number is less than 1 because L40 is a smaller number than L30 because there's fewer people alive at 40 than at 30. So there's 3 ways you can write that formula. 10p30, 1 minus 10q30, or L40 over L30. So you got several ways to approach it. What is the probability of a 40-year-old dying in the next 10 years only using L's? Well, L40 minus L50, that's going to be all the D's. It's going to be D40, D41, D42, D43, all the D's. So if you take that and divide it by L40, real important, you divide it by the beginning number, that gives you the probability of the person dying. We know 10q40 is the right answer, but if you can only use L's, that's the way it's going to look like. Or it's 1 minus 10p40. Or we could write it as 1 minus L50 over L40. So there's really 4 ways to write that one. All right, so let's look at this one. L30, we should restate it in English. The number of people alive at age 30, and we add the people who died at age 29. Anyone, what's the easier way of writing that? People alive at age 30 plus the people who died at age 29. L, is it 31, 30, 29, 28? What is it? Isn't it L29? So we take L30, we add the people who died during 29. L30 plus people who died, L29. So that 99311 people alive at age 29. Takes a little practice, but if you say it in English versus just looking at the letters, it becomes a little easier to handle. So L30 plus D29 is L29. L29 over L28. That sounds like P28, doesn't it? L30 plus D29 is L29. L29 over L28 is just P28. But can you see how if you use a mortality table, it can help make sure you're thinking about it correctly. You could have just added those two numbers, L30, D29, you would say, oh, that's L29 sitting right there. All right, this one's a tricky one. So L48 minus L50. So what is L48 minus L50? D48 and D49. It doesn't include D50. Y'all see why it doesn't include D50? Because L50 is people alive at the beginning of age 50. So L48 minus L50 is D48 and D49, does not include D50. But then there's D50 right there. And then L51 minus L58, well, that's going to be D51, 52, 53, 54, 55, 56, 57, but not 58. All right, if you take L minus L, the second L does, whatever that is, does not include the D there. It only includes the D for the year before. So essentially we got D48 through D57. So that's going to be 1 minus 10P48 or 10Q48. It's just good to get some practice with the table. The probability that someone who's 48 today will die in the next 10 years. Or the probability that someone who is 48 today will not be alive at age 58. That's another way of saying it. All right, this one's a crazy one. I won't ask you anything like this, but it's good practice. Mary's 35, her husband's 33. What's the probability they are both dead by the end of the year? Mary's current life expectancy. So she's 35. So what is her life expectancy? So we go find, now, obviously this is a male table. I'm using a male table for the wife, so it doesn't make sense, but let's assume it's all one table. So we take L35. Y'all remember what we do with it? Divide by 2, you'll take half of it. So we're looking for 49,113. So let's just use 75, because if she's alive at age 75, she's going to die before age 76. She's going to die somewhere in her 75th birthday. So her life expectancy is 75. So for her, it's going to be L35 minus L76 divided by L35. And her husband, we're going to add the same number, 31 years, L33 minus L74 over L33. And the probability that they both die is 23.5%. That's a pretty high probability that they'll both be dead by that time. I don't like these questions because of that confusion. Is it age 75 or is it age 76? I generally go, it's the year before you go past it. So if we're looking for 49 something, it's 50 because she's going to die at the end of age 75 on average, 50% of the time. But it's still a confusing question. The probability of an individual alive who is 25 today will still be alive at 75. So here's a big question. This is going to be a big deal when we do one of our problems, is how do you handle this? And when you're talking about alive versus alive, you can just subtract. It is just 45. It is just 70 minus 25. You don't have to say, well, it's that plus 1 or that minus 1. It is just that subtraction. 45p25 or L70 over L25. So that's good to know. L70 over L25 is the same thing as 70 minus 25 or 45p25. I am going to give you a trick how to do that in this one problem that's really, really critical. Because you have to remember that people are alive at the beginning of the year, they die at the end of the year, so you have to take that into consideration. There are some times where you will add 1 to the number and other times you won't. So you'll see that when we do the problem, we'll get some practice with it. All right, joint probabilities, they can both die, they can both live. One can die, one can live, one can live, one can die. So what's the probability that 2 individuals, one who's 50 today and others who's 60 today, will both be dead in 10 years? So it's 10 Q50 times 10 times 10 Q60. So if we think about it, 10 P50 times 10 P60 plus 10 Q50 times 10 Q60 plus 10 P50 times 10 Q60. What's the last one I have to go? Just to see if you're following me. I got one more to go. What do I have to go? Got 2 P's, 2 Q's, and Q50 times 10 P60. And that should all equal what? 100%. Those are the only choices. All right. So this is going to be important when we do joint life, because joint life pays either dies or they both die. So when's the only time the joint life's not going to pay is when they're both alive. Would you rather do 1 minus this, or have to calculate these 3 and have to add them together? I'd much rather do 1 minus that. That's a lot easier. So you can see when we do joint life, that will be an important consideration. Using P's and Q's, write equations which would provide the probability of the following: probability that a woman who's 85 years old and her husband who's 50 both live another 5 years. 5p85, 5p50. That's my aunt and uncle. She was a good 30 years older than he was, and she lived a very long life. I think he was trying to wait her out, and she just kept going and going. She might have outlived him. Or you could do L90 over L85 times L55 over L50, but I didn't ask for that. I just set the P's. Probability that individual who's 45 today will live to be 60, 15, P45, L60 over L55. What about dying? 1 minus 15 P45, 15 Q45, 1 minus that. Or you can subtract and divide by L55, 45. All right, so here's a tricky one. Probability that at least one, but not both individuals, one who's 40 and one who's 45, will be dead in 25 years. So we don't want 2 Q's because it says not both. So the Q and the Q has to be out of there. The P and P has to be out there because we see at least one die. So that's going to be the P times the Q plus the Q times the P. All right. Mortality rate at age X is best shown by which of the following? D30 over L29. What does that tell you? D30 over L29. That's a very nonsensical number. Doesn't make any sense at all, does it? I don't know, I can't think of a time you ever use that number. L31 over L30. That's not their mortality, that's the opposite. That's their probability of living. L31 over L30, that doesn't work. D29 minus D28, D30. I don't know why we would ever subtract D's. That doesn't make any sense to me at all. So that one we can leave out. So here we have L30 minus L31 over L30. That's exactly what it is. Okay. You see how I always go to the mortality table to get these, so I refresh my mind what we're doing. What is the probability a man aged 25 today will die either in his 70th year or in his 80th year? You got to be real careful. You can't, 100% is not D25 over L25 plus D26 over L26 plus D70 over L70. That does not equal 100%. And the reason we know that's not true is because D99 divided by L99 equals 100%. That one by itself equals 100%. So the others don't equal 100%. How do you get this? Anyone know what change I have to make this equal 100%? I got to make one little change. These are not easy questions, but I'm always impressed if y'all can figure it out. Takers. Y'all see it right here. What did I change? Yeah, it's always go by L25. If these are all L25s, then it works. Because all the L25s with all the Ds, that's going to equal 100% because you're just adding them all up. All right, so this is a nonsensical one. That one doesn't make sense for some reason, unless you're why that doesn't make sense. Oh, because it's got to be L25. So it's going to be the probability that he died. I don't know why you ever want this. You know, we don't care if you die. Maybe by a life insurance policy only pays if you die at age 70 or if you died at age 80. If you died at age 73, you get nothing. It's a strange policy. But so this is real important. You got to make sure you start with the right L. It's going to be easy when we do the insurance policies because you're always going to use the year that the policy starts. Probability someone age 32 will live to age 34. So we're talking about P2, P32. So L32 minus L34. That is the probability that they die. We could have done 1 minus that and it would have worked. We're talking about the probability of them living. L33 plus D34 means absolutely nothing. L33 plus D33 means something. But L33 plus D34 doesn't tell you anything. Or we could have done L30, I'm sorry, I said it wrong. We could have done L33 plus D32. That would have made sense because that's going to give you L32. D32 plus D33, we're talking about living, that would be dying. That's exactly the same. These two are exactly the same. L35 plus D34, that's going to be L34 over L32. That's going to be the right answer. Y'all can see why the scores are so low in this stuff. It takes a while to sink in. You really got to let it go. So I might not do too many of these. So let's do the pricing so you can see that it's actually not that difficult. So we'll get to mortality table here. So we're going to price the net premium. And so the way it's going to look, so I'm going to go into the mortality table here. And below the mortality table, we're going to do these products. So the formulas are going to look amazing like this. D's in the numerator. and sometimes L's in the numerator. And then L's in the denominator. If it's life insurance, you only have D's in the numerator. If it's a 3-year level term, you have 3 D's in the numerator. If it's a 5-year level term, it's 5 D's in the numerator. If it's whole life, you keep adding D's until you hit D99 and then you stop. So that one's tough. It's hard for me to give you a whole life. I'm not going to give you a whole life policy to a 25-year-old because you're doing this with paper and calculators. That would take you forever. And I'm not giving you the M and the N, which is, a little bit easier to work with. So same thing on the denominator. If it's a 3-year level term, you're going to have 3 L's in the denominator. So 3-year level term is going to have 3 D's in the numerator, 3 L's in the denominator. If we're doing annuities, you're going to have L's in the numerator and L's in the denominator. If we're doing an endowment, we're going to have D's and L's in the numerator and an L in the denominator. So we'll look at each one of those. So we're going to start very simple here. I don't know how many we're going to do about this. We'll do a bunch of them. All right. So let's try this first question, which is one I will not give you on the exam because it's just a little too ridiculous. Annual renewable term. So the face of the policy is 10,000. The reason I like to do 10,000 instead of 100,000 or a million or 500,000, it just makes the calculations a lot easier to do. Y'all have the file open. Y'all find it. Who was it? Was Katie? Did you get it to work? Finally? Okay. So hopefully it works on your machines. The rate investment return is 5%. And the issue age is 30. So we need L30 and we need D30. Very, very simple. So L30s, these are our premium payers. They're going to pay the premium, and these are our dyers. I don't know if dyers is a word, but these are our dyers. It probably is a word meaning like dye clothes or something, but I don't know how to spell dyers when you're talking about people dying. I don't think it's DY, it's probably DI, but I don't know how to do DI if it's. It's even worse for the livers because I call them livers, and there's another means something else as well. All right, so L30 is 99,141. And D30 is 172. So let's do our first formula. We're going to take D30 times the face, divide that by L30, but we have to make one adjustment. And the one adjustment is, when do we pay the D30s? Do you remember when people die? At the end of the year. So we've got to adjust that. So we're going to divide that plus 1 plus the rate to the first power. So you see what we're doing? We have to have the cash flow that's going out, take the time value money of that, take it to the present value, and then we're going to divide that by our premium payers. let's try it. So we've got D 30 is 99, I mean, it's 172. We're gonna pay them $100,000. And divide that by 1 plus 5%. Rates of the first, and divide all that by our livers. It gives us a premium of $16.52. That seems high to me, but we'll test it. So how do we test it? So at time 0, we're going to collect our premium. That's going to be L30 times the premium. So L30 is 99,141. We're going to get $16. So we're going to get $1 million, 638, 95.24. We're going to invest that at 5%. At time 1, what happens? The portfolio matures. And how much is it worth? Well, we'll take that number times 1 plus our investment rate, because we invested at 5%. And I'm probably going to get a really, really round number. And why am I getting a really, really round number? Because what I'm going to do, I'm going to pay claims. So my claims are going to be D30 times the face. So D30 is 172. My face 100,000. And it all worked out perfectly. Everybody's clear on that one? You can see why I'm not going to ask you that in the exam. This is not much to it. So let's get a little bit more interesting here. Level term policy. Y'all tell me if I'm going too fast. This is a very, very unusual level term policy because it's a single premium level term. You're not going to see that anywhere in practice, so you won't see this on the exam either. But I want to get you used to putting the D's in the numerators before we start putting multiple L's in the denominator, because it can get a little tricky. So our face here again is $10,000. Our investment rate is 5%. Issue age is 30. The term is 3 years. So you already know you're gonna have 3 D's in the numerator as soon as you see that. And the single premium means you're only gonna have 1 L in the denominator. So what do we need? We need L30. We need D30. What else do we need? D31 and D32. So let's go get L30 again. And then D30, that 172. 31, 32. So there's all our data. Everybody with me? So the formula here it's a little bit more complicated. It's not bad. So we have our D30s, and they're going to get $10,000. But we're not going to pay that for a year from now. All right, so we're going to take that payout, and then we have our D31 times 10,000. We're not going to pay that for 2 years. Raise that to the second, plus D32 times 10,000 divided by 1 plus 0.05 raised to the 3. So there's our numerator. We divide all of that at whole 30. So, seeming logical, everybody? Let it sink in. Just know if you have a 3-year level term, you have 3 Ds starting with that first year: D30, D31, D32. So it's going to be a much higher premium because we have, more, about 3 times more people dying. But let's set it up and see if we can get it to work. So D30 times $10,000 divided by 1 plus 5% to the first plus D31 times $10,000 divided by 1 plus 5%. The second, if I get it wrong, it's going to be because I put parentheses in the wrong place, which is real possible with this. All of that divided by 30. That looks about right to me, but we'll see. Anybody else getting that number? Now on the exam, a couple of times you'll have to actually get me the 4840. But most of the time, this is all you're going to have to do on the exam. Write it just like that. But the D, you don't have to go look up the D. Just write D30. That saves you a lot of time. Write the face in. Don't write the word face. Write the 10,000 in. And then put the rate in there. But you don't have to look at the D's and the L's. All you have to do is just put D31, D30, D30, D31, and then put everything else in there. That gives you full credit if you do that. So you just have to write it out like that. So let's test it. At time 0, we're going to collect the premium. That's going to be L30 times premium, and that's the only premium we're going to collect. So the L30s to premium, it's going to be a pretty good size number. Then we're going to invest it 5%, and that's time 0 is out, done for. We're done with that. Then time 1, portfolio matures. Take that, all those premiums we received, we invested it at 5%. They were going to pay claims. It's going to be D30 times the face. Then this is the net portfolio. We're going to reinvest at 5%. And then I wish I could do the exam on Excel. That would be much nicer. But you don't really have that much of an issue because you only have to work 2 of them out. So it's not too bad, but it still would be nicer. Time 0 to time 2, portfolio matures. Your ending portfolio matures. Pay claims. Here is going to be D31 times the face. So your net portfolio. Then time 3 looks exactly the same again. Portfolio matures. If I did it right, I'm going to get a really, really round number here, but we'll see if I did it right. That looks like a round number. And you pay claims. Your D32 times the face. What do you think D32 is? 181 maybe? Is 181 face. Right there is the definition of the net premium. The net premium is the exact premium you need, so at the end of the time you have zero money left. Okay? Now, obviously here, we can't charge them 48.39585210481141. We can only charge them 48.4. So that's going to be an issue for you on the exam, because it will cause a fairly significant difference. Rounding does cause a difference, so you just have to be aware of that. It can be a few $100s. The only way not to have that is if you don't have the rounding in there. This case in particular, it's a big problem because it's 39.5. It's not like 39.99 something, so it gives you about the biggest difference that you can get.
Possible to have you post this once after class?
Well, the last semester is already out there, and it's the exact same problems. So I think it's under miscellaneous materials. Mortality table with work problems. I'll post this one once we're done, but that one you have, it should look very, very similar. So we got 2 down. The next one is practically identical. It's a whole life policy. Now, if we did this one as a whole life policy, what would I have to do? I have to do D33, 34, 35, 36, 37. How long would it take you to do that on an exam? Even if you have to work it, just to write it all out, you've run out of paper. So I'm not going to give you a whole life policy issued to a 30-year-old. Instead, I'm going to give you a policy that is ridiculous, which is a whole life policy issued to a 97-year-old. You would never do that. And it's a single premium whole life. You would never do that either. So it's the exact same problem, except we go until we get the 99. So that's the key. Anytime you see whole life, you keep adding premiums until you get the D9. I mean, you keep adding Ds and you get the D99. This is a single premium whole life. Another thing to remember is an ordinary whole life, what that means for the premium. We'll talk about that when we do that one, but this is a single premium whole life. So there's 3 types of whole life: single premium, limit pay, and ordinary. So this is single premium. So that means we only have 1 L in the denominator. So I'm going to cheat. Y'all can't do this if you don't have an Excel, but I'm going to cheat by just copying this previous problem down because it really is the exact same thing. Makes it a lot easier. I didn't think I had merged cells. Where are my merged cells? I think Bill Gates is wrong on that. Did I have a merged cell? Oh, I did have a merged cell, didn't I? No. Well, I wanted to copy it down, but Bill Gates won't let me. All right, one last time. All right, well, we'll do it.
I think there's a first cell like further down. You know, if you have one, you just.
Oh, down there. Ah, I see. Ah, crisis. I didn't think about that. Okay. Let's see if Evan's going to save the day here. Probably so. All right, good job. All right. So the issue age here is 97. It's whole life. So we need D97, L97, D97, D98, and you just keep going until you get 99. So just change 97, 98. Now, is this premium going to be higher or lower than the 30? Slightly higher or ridiculously higher? So how many of these people are going to get the $10,000? How many of the L97s are going to get $10,000? Isn't it every single one of them? So that's going to make a big difference. So let's go find L97. Let's go find D97. And there's our premium. 9,211.77. So the 97-year-olds, they're going to get $10,000 and they invested 9211. So they're going to make a 9% return. The D98s, they're going to make that same return, but it's going to be spread over 2 years. So they only make about 4% a year. And then the D99s, they're only going to make about 3%. And that's the way it has to be. Y'all see that. So they're going to make only about 4% because I mean, if I did compounding, it'd be different than that. And they're going to make 2.8. So the D97s are going to make more than 5%. The 98s and 99s are going to make less than 5% because the insurance company is only making 5%. So they're essentially going to be splitting that between them. Let's see if it actually works. Your premium, you collect a lot more. So there's your D97 times the face. There's your D98 times the face. D99, and you're done. So much higher premium. Would you ever sell a product like this? You've got a 66% chance of getting a really bad return. You got a 30% chance of getting a decent return, but not a great return. Doesn't sound all that wonderful to me. But anyway, that's the whole life. I mean, yeah, the whole life. All right. What happens when we add premiums? More than one premium. This is the last little complication other than the endowment and the joint life. So, and you're going to do something that your parents told you to never do, but in this class you can do it. So we got a 3-year level term. You know you have 3 Ds in a numerator already. It doesn't say anything about premium payments. It doesn't say anything about premium payments. It's a 3-year level term. You have 3 premium payments. So a 3-year level term has 3 Ds in a numerator, 3 Ds in the denominator. If it's a 10-year level term, you have 10 Ds, 10 Ls every time. All right. But what do we do with those premium payers? Because they're going to pay this year, but then they're going to pay again a year from now, and then a year from now. How do we do that? So we're going to do something that sounds really bad. We are going to discount people. You're probably used to discounting dollars, but we're going to discount people. Okay. So our face again is 100,000 here. I don't know why I increased it. Our term is 3 years. Issue age is 50. Interesting policy. So I'm going to need L50, L51, L52. I'm going to need D50, D51, and D52. And so here, formula here, the first introduction, the numerator is exactly what we did before, no difference at all. So D50 times 10,000 times the face, 10,000 divided by 1.05, raise the first. Sorry? Oh, 100,000, yes, thank you. Plus D51 times 100,000 divided by plus 0.05 raised to the second plus D52 times 100 divided by 0.05 raised to the third. All right, so notice this is 1, 2, and 3 because they die at the end of the year. When do they pay their premium? Beginning of the year. So when we do the premiums, it's going to be 0, 1, and 2. Okay, so the denominator, take L50 plus L51 divided by 1, 0.05 raised to the first, because they're going to pay exactly 1 year from now, plus L52 divided by plus 0.05 raised to the second. So this is pretty common when we see these other products. Your outflows are going to be a year later than your inflows. Now, there is an exception if we're doing annuities, because we pay annuities to people who are alive. So in that case, your L's are at the beginning of the year. So we're going to see how we're going to have to adjust for that when we do some of these more complicated products. But in this case, when it's life insurance, the D's are 1 year later than the L's. So let's go get our data here, L50. D1, 52, D50, 152. Right, so then it's just plug and go. So D50 times $100,000 divided by 1 plus. Oh, I forgot to put the rate in there. What was the rate? 5%. Okay. So D50 times $100,000 divided by 1 plus 5% first, plus D52 times $100,000 divided by plus 5%. The second plus D52 times $100,000 divided by rate raised to the third. So there's my numerator. Bill Gates didn't like it, but hopefully it's correct. I really need these parentheses, so I'll try to get rid of parentheses. That's right. So we're going to pay out in present value terms, we're going to pay out $183 million. Sounds like a lot. So our premium has got to be that much, but we've got 276,000 people to pay premiums. So we're going to spread the premiums over a lot of people. So there's the numerator. Denominator is a lot easier to do. L50 plus L51 divided by 1 plus the rate raised to the first plus L52 divided by 1 plus the rate raised to the second. So our premium, just divide those two out. The premium doesn't look all that bad. These are 50-year-old people, so you kind of expect a higher premium than you would for a 20-something-year-old. But $695, and these are annual premiums. We're not even doing monthly. Monthly may be much lower. So $100,000 policy, 3-year level term for a 50-year-old is going to be, $50, $60 a month kind of thing. All right, so let's test this out. I'm going to go kind of quickly on this. I'm going to do some copying. So we collect our premium. The L50s times the premium. So we're going to get a lot of money here. Gonna feel really rich, $640 million, $64 million, and we're gonna invest 5%. Time one, the investment matures, but what else happens at time one? It didn't happen in the previous one. Collect the premium. So we get that times 1 plus the rate. And then we're going to take L51 times the premium. So boy, we're really rich, aren't we? But we still got one more thing to do. What else do we have to do? Pay claims. So our D50 times face. Now you may say I have it in the wrong order. I think I do have it in the wrong order. I probably would have put pay claims first, then collect premium. It doesn't matter because they all happen exacts. There's like a millionth of a second between them. At 11:59:59, the D50s die. The next second, they pay their premium. So it's all the same time. We're not going to discount things for a second. So we take D50, D50 comes our face. For any portfolio is our investment plus our premiums minus that. So we reinvest 5%. So now we can essentially just start copying this stuff down. Time two, our investment matures. Collect our premiums from L52. We pay our claims, the D51. D51, where are you? And that's the money we have left. And then time three, this is our last time. Well, no, I guess. Let's see. We got L50, L51, L52, so we don't collect any more premiums, right? We got D50, D51, so we're not going to collect any premiums here. So D52. That's the face. So I'm expecting a very round number here. Let's see if I get it. Oh no, I didn't get a round number. Why not? What did I do wrong? All right, we did something wrong. That's not good. Anybody see the problem? Maybe I did it on purpose to see if you are paying attention. So D52 times 100,000. All right, let's find the errors. So we collected our premium. L50 is line 183. $183 times 97 looks good. We invested 182, 5%. That looks good. L51 is 92. That's row 184. 184 times 197. That looks good. We pay our D50. 622. That looks good. We add the beginning portfolio plus a premium minus the how much we paid out. We then mature that at 5%. L52, did I get that one right? 185. Ah, there's the problem. Did y'all see that when I did it? So I was off 1 year there. Does that look better? So it has to equal 0 because that's the definition of a net premium. So it has to come down that level. So you can see what your formulas are going to look like. You can have D's divided by over L's. That's just going to be your formula. You're going to have face up here. You're not gonna have any face value there. You just see it over and over and over again. So we really haven't done 4 or 5 products. It's really the same thing, just how many payers. And one thing you can be pretty sure of is I'm not going to give you any single premium ones. So all of yours is going to have multiple L's in the denominator. It just depends if it's 2 or 3 or 4 L's. Okay. Now, real critical, make sure you put this in your notes, because if you ask me on the exam, I'm going to say I have no clue. I don't know the answer to that. The word ordinary means that the L's in the denominator have to be the same number as the D's in the numerator. Ordinary means you keep paying premiums until age 99. Okay, so if it's an ordinary life at age 97, you're going to have D 97, 98, 99. You're going to have L 97, 98, 99. That's what the word ordinary means. So I won't define that on the exams. Make sure you have that in there. But it's exactly what we just did, isn't it? There's really no difference between that and this one. You're just going to use the 97s in there. I'll copy it down real quick, but it will be the exact same problem. Assuming you have one. Now, in ordinary whole life, more than likely you're going to get to just write the formula. So make sure you're looking at exactly how I write the formula. I do want you to put the actual face in there, put the actual interest rate in there. You don't have to do plus the rate if you don't want to. You can just do 1.05. And then the L's, L97. If you look up the D97, write that in. Not only does that waste you time, but it makes it really hard for me to grade it, because now I got to go look at the D97. So don't do that. Just write D97. And be real careful, because I don't always use a 5% discount rate. So you're getting in the habit of using 5%. So in the exam, make sure you look for it. So we can essentially copy this entire problem. So it really is exactly the same. Just do 97, 88. Nine, 7, 8, 9, L97, D97. The formulas are off, but I can do it real quick. Now this is going to be a really big dividend, isn't it? Premium. But it won't be as large as the premium before. Remember, the premium before was what, 9,000 something? Why won't this be 9,000? I have 3 times more, or many more premium payers, don't I? 97, 98, 9. So the premium will be smaller. So let's see if we got this. This might be correct here, because I think everything is lined up. So I don't think I have to change anything. So there's your premium. It's only 55,000. It's not 97,000 like you would have seen. The previous one was 10,000. This is a $100,000 policy. So it's 55. So now think about it. The people who die that first year, they've made a really good return, didn't they? 80% return. The people who die the second year, they have to pay 2 premiums. Oops. They're going to lose 10%, but over 2 years. So they're going to lose about 5% a year. And then the last people, they're going to get $100,000. They have to pay that 3 times. They're going to lose 40% over 3 years, about 15%. So it doesn't make sense as a product in and of itself, because it's just who would spend $55,000 when you have, one chance to make a huge return, and yet one chance requires you to die early as fast as possible. It doesn't make a lot of sense. let's see, did we get the 0 at the end? Looks pretty good at the end. So it works. So there's my L97s, L98s, T97s, 99s, 98s, D99s. So it works really, really well. I find these fascinating because it is, to me, it is kind of interesting what kind of premium you get. We could price a regular whole life policy for a 25-year-old, and it's pretty easy to do because I'm going to take 177 times 100,000 divided by 1 plus 0.05 raised to whatever is there. What's going to be right here? 1. Do the same thing. Oops. The same thing here, but we'll make that 2. So you can copy that all the way down to the end. And that's your, what year did I start in? I think I skipped a line. Let me start, wait, sorry. So there's your numerator. It's gonna be a huge number, probably won't fit in this, well, there it is, okay. And then what's my denominator? Well, I got that divided by 1 plus 0.05 raised to that minus 1. Base doesn't like that, but I think it's right. Copy that down. Does that seem correct? So there's my denominator. That divided by that, you would pay $676 for a $100,000 policy for a whole life policy for the rest of your life. Now that sounds really high, but what I need to do that? You're only going to be paying it monthly, so it's $56 for $100,000. What happens if you die the second month? You have a very handsome return. You had to die to get it, but you still have a really handsome return. All right. So you can see if you had Excel, I could give you much more complicated problems because you can just copy this stuff down. It's pretty straightforward. But that's all insurance is. It's just discounted cash flows. And it's discounted premium payers, whatever you call that, discounting people, because we have to account for the fact that they're paying a year off from each other. But it's really not all that complicated math. If I were to tell you that, how are you going to adjust for the dividend, for the death benefits, given that the people paying premiums are going to be 1 year off? You might not have thought it was just so obvious just to discount both of them, but that is all there is to it. It really is quite simple. Now, think about this in terms of an annuity, because on the exam, I tend to give annuities. What changes here? What changes here is we're not using the people dying. We're paying out to the people alive. So your numerator now has L's instead of D's. And so it gets a little squirrelier, but you'll see some of those problems when you bring them up, right? So let's, oh man. All right, limit pay is a piece of cake. Well, I'll stick that into the spreadsheet, but piece of cake. Limit pay, if you only pay premiums twice, is it very difficult to figure out the policy here? What are you going to do? L97 plus L98 divided by 1.05 and you're done. Very, very simple, isn't it? We don't really need to do that one. I can stick it into the spreadsheet. Let's talk this next one. We'll actually work it next class because this is the massive one on the exam. This is the most time-consuming one on the exam. So we're going to do a 3-year endowment policy. When you see endowment policy and it says 3 years, the 3 years tells you how many D's there are. Right? The way the endowment policy works is it pays the death benefit if you die, And then at the end of the 3 years, which is actually in 4 years, if you're still alive, then it pays you the face. So you can get the money whether you're dead or alive. If you die, you get D's. If you live, you get the L. So the premium is going to be D50, just a 50-year-old, D50 discounted, 51 discounted, 52 discounted, and then L53. But what do you notice about this? It's also raised to the third power. Because the livers at the beginning of the year, the dyers at the end of the year. So you're going to pay these people, you're going to pay the D52s and the L53s at the exact same time. Now, someone discovered, an actuary student actually discovered I could simplify this very much. Can anybody think of how I could simplify this last part? Since they're both divided by 1.05 to the third, is there any way to simplify this down? What is L53 plus D52? L52, couldn't I just make this L52? So you could do that. So you're going to pay the D50s, the D51s, and the L52s. On 1, 2, and 3. You can write it out longhand if you like. The reason this is the longest problem is this is the one to actually make you calculate the numbers. And guess what? Don't groan, but it's the one problem you have to write this out from. So it's a heavy calculation problem. All right, I only have you do it once on the exam. So I want you to calculate the premium and then work it out so that at the very end. Now, at the very end, you won't have zero because of rounding, but you should be within a few $100s. I try to rig the problem so that with the rounded number, you're still pretty close, so you don't panic and say, oh, my word, what I do? So I'll try to make that so you're not off like $1,200 and you're scared of that. So we'll do this on Tuesday. I'll plug this one in there. And then on the exam, you will have one incredibly crazy problem. We'll work a few of these. The first time I did this on an exam, I had one student get it right, and it wasn't an actuary, it was a finance major. So actuary students, the pressure's on. Once I started working them in classes, more and more students. So now I'm up to about 50, 60% of students are getting them. I want to get 100% to get them. So I'm going to try to help you understand how to put this in here. The trick here is the ends. Is the end, is it 50 or is it 51 or is it 49? So I'm going to give you some tricks. If it's a D, it's probably going to be N plus 1. It's probably going to be the difference plus 1. If it's an L, it's just going to be the difference. We'll talk about that. How do you tell which one it is? So this is the first one I gave to that first class. Only one student got it right. But I'll go back and get other previous exams and show them to them. I'm running out of ideas to make them crazy. So they're kind of, but it's to make sure you know how to handle the time value money with the mortality table. So they're crazy problems. It's not like 50% of the exam, it's like 7% of the exam. So if you completely miss it, you're off. What the most irritating thing to me of all are the students that leave that completely blank. There's some obvious stuff you should at least get down so you get at least 10% credit. So, all right, so we'll do the limit pay whole life next time. And do these others, and you might be doing it by Zoom, so make sure if you get on Zoom that you have the Excel open, ready to go.